Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hello and welcome back to the Australian Retirement Podcast. This is James O'Reilly and I'm joined today with a magnificently tanned Drew Meredith. Hello, mate.
Appreciate that. Yeah, we're coming back after what seems like an extended break over Christmas as well. Obviously not a break for the podcast, which has been released every Thursday night. And coming back with some fresh content, rejuvenated, full of vitamin D.
So you look good.
Been out and about a lot.
This is going to be a really good episode because not only is something that's incredibly important for a lot of retirees and pre-retirees, it's also something that we're really going to lean into in 2025 to make sure that we're helping them all as much as we possibly can. The focus for this particular episode is around knowing if you've got the right super fund. Drew, how many times in your life as a financial advisor have you had someone say to you, "I'm not certain if I'm in the right super fund"?
I think at least 3 times a day, to be honest, every single meeting. And even and a lot of the time it isn't whether they even think they're, a lot of the time people don't even consider what type of super funds are available, and that's probably a blight on part of the industry as well, that we're not necessarily aware of the 4 different types of super funds we can invest into. I've added one from the normal 3 because there is a bit of complexity there. Because the nature of the system is we're defaulted into one, and we're usually defaulted into one when we're 18 or 19 and never really think about it until we move into our 50s. So yeah, it's every conversation, and any financial plan is basically the core of that is trying to find the strategies, obviously, but also the products and solutions, which a super fund is, that are suited to each person. And there's all different reasons and all different characteristics that make different super funds suited to different people. And that's why this one's so exciting. We're going to try to stay objective during this episode. It's my ultimate aim.
I'm going to hold you accountable to that as we go. Yep. So we'll do our best.
We do have opinions. You've been in the industry for long enough, and turning into 2025, I now have to say I've been doing financial advice for 20 years. I know you're probably longer because you were working in your dad's business when you were
I've been in for a while. And yet, as the years go on too.
How many super funds do you think we've reviewed in 20 years of experience?
I don't want to think that's not going to make me feel better about my life. I don't think. It's a big number. Yeah, but to confirm, as we do this, I mean, this episode really is designed to help you to understand the parameters. If you're thinking about, am I in the right super fund? Here are the primary things that you should be thinking about. Now, we know that there's lots of places that you can go online if you want to get your super fund reviewed at a really high level, i.e. 4 stars out of 5 or 4 apples on ChantWest or whatever metric exists. But one of the challenges that I feel is real for most Australians, and particularly as you are approaching retirement, is that it's not so simple, because the things that you value and how much benefit you're going to get from different features, they're not possibly weighed up by these ratings agencies. So there are super funds that, in my humble opinion, do really, really well, and they're great funds for people in their 20s and 30s, and they become terrible funds for people in their 50s.
For sure.
And so as part of that, we're going to try to not just talk about the key things that make a super fund good or bad, but then also practically help you as the listener to understand, is this something that I should weight heavily, or is this something that I can say, well, that's not such a big deal in my case?
And it's incredibly difficult because aside from these research and ratings agencies, which aren't, they're great for advisors, but not necessarily as accessible for individuals, there's no templated way that super funds have to report. It's the same as there's no specific way that ETFs or managed funds have to report. If you want to find the same information on 10 different funds, you have to go to 10 different parts of different websites and navigate in all different ways. It's not all that straightforward. The information is straightforward, but it can be incredibly difficult to put it all together. And as much as the ratings agencies are helpful, it's very difficult information to find.
It is.
And
let's start with the important question, if I may, which is, how important is it to choose the right super fund? What are your thoughts?
Your superannuation outside of your home is going to be probably the biggest asset you have in your entire life. and making sure it's aligned to what you're looking for. And that could be aligned in terms of transparency, in terms of options, in terms of preferences. I know something important to your business is sustainability and the sustainable investment options. So increasingly people want their superannuation and their money to be invested in line with their
economical preferences.
Yeah, exactly. Yeah. So I think it's so important, and different people value different things. If you want control, certain super funds are better for control. If you want transparency, certain super funds are better for transparency. But not everyone wants all these things. So, and I think this is probably a good reminder that there is a super fund for everyone, and it is about kind of understanding what you're looking for, what makes you feel comfortable. Whereas a lot of us just, and I probably did the same thing for a few years too, is you just assume that you don't see it as your money, so you're not engaged with it, and you don't really think about it too much, and it just sits in the background. So hopefully, if maybe a public service from this episode is to encourage people to engage with their super fund, whether you're young, old, in retirement, not retired.
Yeah, well said. All right, give it to me. Crash course. What are the 4 super fund types?
Yeah, I've added, and I think you have to add one now. We've always said there were 3 historically, and that's an industry fund, and they're different names for that. They used to be called not-for-profit, but they're profit for members. There are self-managed super funds, and you're talking about 2 very different ends of the spectrum there. And then in the middle, we used to call it corporate funds or retail funds. So there'd be something like Plum Super or Colonial First State historically. And then there's this growing cohort of, so that's like one that's provided by your employer. And then there's a growing cohort of advisor-initiated superannuation funds. And that's things like Hub24, Net Wealth, BT, a growing list of them. And they all represent quite a large portion of the superannuation industry. I know industry funds are the biggest, and then SMSF's slightly behind from memory, and then retail funds kind of sit just behind them. So they're all like a reasonable, I think, 20 to 25% as a minimum part of the industry. And you go from complete control and transparency to essentially very little control and transparency to this kind of sweet spot in the middle, depending on what people are interested in. And I think, we'll go into it later, but there's essentially you're reviewing funds, the fees charged in financial advice. I try and put this simply: is there's advice fees, there's investment fees, and there's administration fees, and each of these has different approaches. But I don't want to preempt that part of our analysis, as I tend to.
All good, my friend. This is good. Well, let's top down talk about the things that we believe make a constituents when we're measuring a good fund. The things that we've got here, just without chunking down, we've got firstly investments, so your investment options, the investment team that's making those decisions, and also the performance of the investments that are available in the fund. In addition to that, we then go down to investment fees. So I suppose more specifically fees, not just investment, but admin fees, like advice fees, all of those all-up costs that you might pay if you're in that fund. Insurances, what's available for you there is obviously incredibly important for a lot of Australians. A huge amount of Australians have only got insurance that is inside their super fund, and that's a whole problem in and of itself. But therefore, the quality of the insurance that's gifted to you is incredibly important. We think access and communications, what you get back, including, for example, the not just what
ancillary
you get mailed to you, but also you pick up the phone and you want to make an inquiry or send an email. How easily is that facilitated, and how simple are they to work with? The perks, the quirks, the good and the bad, and for each individual fund, and that's obviously going to be quite specific to each fund. And if we go through those things, we reckon we're going to be pretty well positioned to make an evaluation of not just how is your fund if you're playing at home, but also how does any fund match against its peers? Is this a good fund? Is this a rubbish fund?
Yeah, this gives us a framework to go through SMSFs of different. There's different types of SMSFs to go through corporate retail funds of different types, and I kind of look forward to doing that throughout the year as well. And it's probably worth reaching out if people have a fund they want reviewed. And I'm sure we'll get some pressure, some pushback, and some commentary from those funds we are reviewing, particularly me. But to reach out identify funds, tell us the questions that you've got about your fund, and obviously keep it anonymous and fund names, so we're not providing specific advice. But it's always important for us to understand what people are worried about, what they aren't sure of when it comes to their superannuation assets. And I just think engagement's so incredibly important, and these can be difficult areas to get deep information from, or to make a real decision.
Couldn't agree more. All right, let's get started and let's talk practically about how people can evaluate whether they are in the right funds. And in the context of that list we just put forward, the very first thing to talk about was investments, investment options, team, performance. So if you are thinking about or seeking to understand if you're in the right super fund, mate, what are the things that you think that people should be thinking about with respect to the investments within their super fund?
So the biggest one here is understanding the different types of investment options, and more options isn't always the best outcome either. Sometimes less options is better. By default, we're always placed into a My Super, so it's a special part of the legislation where the government essentially made sure you weren't put into a super fund that wasn't overly inappropriate. But there's three types of investment options, and this is what investors or superannuants or account holders should be looking at. The first one you look at is multi-manager or risk profile, we call them. We've got two different names. The second is single sector, and the third is DIY or self-directed. At that high level, we as a listener, you've probably heard us talk about a balanced investor, a balanced growth investor, a high growth investor, conservative, moderate, and then there's probably 15 different names you can use for these two. But essentially, you're outsourcing every investment decision. You've made an assessment, or the super fund's made an assessment that you're a balanced growth investor and you need a return of a CPI plus 3 to 4, 4 to 5, whatever it happens to be, and your portfolio will be managed for you within a mandate of a certain range of your portfolio invested in different asset classes. And then the multi-manager name comes through because what is generally happening is that your super fund doesn't do it all themselves. They outsource parts of these investments to different investment managers, to ETF providers, to individual portfolio managers, and a whole cohort that brings it all together. And one big thing I say is you can find this information if you dig deep enough on most superannuation fund websites, whether they're industry or retail. You just have to look for it, down to the amount of hundreds of millions of dollars they have invested in any individual bank account. You can't find the BSB, but that's it. The second, this drills down to the second option, which is single sector. And from an industry fund perspective, this is the way you can control part of your destiny when you're investing.
This is sort of like the first step of having more control from when you branch away from the traditional what the super fund gave you, right?
Yeah, exactly. And this is, instead of outsourcing the asset allocation and the investment selection decisions to your super fund, you're controlling the asset allocation decision. You get to determine, I want more. I would really like, the Trump election, and it's going to do well for global growth stocks, tech. I'm going to put more in the international shares option with my super fund. Or I'm really worried about the market. I'm going to put more into fixed income. So this is where it feels like you can't have much control in this part of the market. But this is where you can start having a little bit of control. And I know you're pretty opinionated on the last one, so I'm going to pass this over to you.
Yeah, I'd love to. While we do that, or just before we do that, thinking about deviating away from the multi-sector approach, what's practically happening there is that they have your super fund has constructed a portfolio that they say for someone who has hopefully your risk profile. And I say that because it's very important to be invested in line with your risk profile. That's one of the most important things, regardless of where you are. If you're a high growth investor and your money's being invested in a growth allocation, you are just throwing money in the bin. And conversely, if you are maybe you're a little bit more skittish about investment markets and you're a conservative or a moderate investor and you're being default allocated into a growth allocation, you are going to walk into some really uncomfortable times when the market gets volatile. So let's assume that you've taken that first step of saying, well, I'm confident that where I'm invested, I'm comfortable with that risk tolerance, and I'm on that cusp of trying to get the best return that I can, but also being I can handle the swings that will exist in this portfolio. If if you wish to move make that first change, what you're doing is saying, I would either like to take more risk by having more exposure somewhere, or less risk by having less exposure somewhere.
Yeah.
And of course, when you take more risk, hopefully there are better returns to achieve that.
I think it's so important you have a framework for this too.
That's right. Yeah. Now, if we go to the next step, thank you. And yes, I'm not cool with this option. And
if you're going to do this, you may as well do it somewhere else. I mean, I'm trying to be objective still. Yeah.
Well, this is when you take that next layer of saying, hey, well, not only do I want to, for example, have more exposure to Australian shares right now, so I've decided to sell down a portion of for example, my default growth superannuation allocation, and I'm putting more of that into Australian shares, which gives me more exposure. Yeah. With the DIY investment option, which is now being increasingly offered by more and more super funds, this enables superannuants, individual investors such as yourself, to hand pick the shares that they want to invest in.
Yeah.
Now, for most superannuation funds, or like your popular public sector superannuation funds, this is limited to typically Australian shares, and typically you're allowed to play within either the ASX 100 or the ASX 300, which means that either the 100 or the 300 biggest shares on the ASX. So you can't take the speculative Medico that will hopefully double in value over the next 24 months. You're investing in your CVAs and your Rios and your BHPs and all that.
Yeah.
But yeah, what I don't like about this is that if you are taking money away from the control of, for example, your Australian share bucket, which can exist in the single sector option, and saying, no, thank you, I want to hand pick the Australian equities that I'm invested in. What you are saying there is, I'm confident that I can outperform this team of Australian equities managers whose job it is to construct a portfolio that's going to deliver a high return. And of course, it's not impossible. There's plenty of successful investors out there that have great success with whether it's Australian shares or international shares or any other asset class. But it's critical to understand what's motivating you to do this. Are you doing this because you're a seasoned investor and for a long time you've got a good track record of just finding opportunities in some of the big positions in the ASX and saying, yeah, I'm going to put in a little extra money there? That's very different to saying, I actually just want to start having a flutter. I want to be more involved with my investments and more involved in my super, because you will pay a price more often than not in the form of underperformance if you want to be having a flutter with your super fund by putting way too much money in one particular position.
And I think it's incredibly dangerous. I talk about this all the time, which is it's very rare to have complete control over your retirement capital. And this is going to be one of the biggest assets outside of ES. So doing that without having a framework or a philosophy or an investment decision-making process, I think is open to risk. And I constantly asked about the value of, the cost of getting advice. And my answer is increasingly, maybe it's obnoxious, is what's the cost of getting it wrong? If you're running your own super and you're investing too much in one sector, there's a significant cost. I think there's a good pivot to this would be straight into one of the big things we both look at when reviewing investment options. So your investment options are fine, but what's the philosophy? How are they being invested? And there's three angles I take at this. And I know you look at similar, and you have a very specific view on one of them. One is how much is internally managed. So how much is that super fund managing themselves? How much of their team? Most super funds now have teams of hundreds of portfolio managers, analysts, and how much is being outsourced to fund managers, to ETF providers, to other groups, because that can be it is a massive driver of returns. And continuing on that is everyone's heard of the core satellite approach. So how much of your portfolio is index and how much is active? You have freedom of choice in super now. So if your fund is performing like an index fund, well, you could actually set up a structure and invest in an index fund and probably do it cheaper. So that question is always important to me. And then the big one, which is becoming increasingly relevant, is the private versus public discussion.
Yeah. Well, let's talk about private versus public for a moment. If you invest in Australian shares, for example, all of those investments are are publicly listed. And what that means is that on a daily basis, say for the weekends and public holidays, they have a live valuation that is evolving all the time based on the market at the time. Whereas if we go to private valuations, the obvious example is your house. There are very few people right now listening to this that could assertively say my house is worth this plus or minus 5% or plus or minus 3%. Whereas you can do that with a share anytime the market is open because the share price moves in line with what the valuation is. And so the challenge that you have, especially depending on the asset, for example, if we think about a number of industry super funds recently and public sector super funds have had big exposures to commercial property. Commercial property's been underperforming in Australia for the last few years. And the flow on of that is that there's been these significant write-downs along the way where the balance moves, or your super balance and or the performance of the investment moves in a really jagged way because there's this revaluation. The last time we did a valuation was 12 months ago or even a quarter ago. And 3 months has been a long time in this market and things have changed. And that can be, that can be really unfavorable because it can leave investors just not having certainty around what the performance of their money is going to do.
Yeah, and if you redeemed your investment one day, it could be 10% lower the next. That's one of the challenges of being in private markets, but also one of the benefits. So you can see private markets as being a challenge, but also as a massive benefit and opportunity because of how the scale of industry corporate superannuation funds compared to self-managed or self-directed investors.
Yeah.
And I think these are pretty interesting and useful when we start talking about performance, because all of these decisions and all of these comparisons are key to how your fund performs in any given year. Yeah. And I was just thinking through this, and it's incredibly interesting that you could have let's say there's 300 balanced growth options available in Australia. There's more, but let's just say it's 300. The divergence in performance of each of these funds, all invested in the same risk profile, is incredible. Mm-hmm. Like in 1 year, you could have a fund return 13% with a balanced growth risk profile, and another one do 3%. Which I think that just stresses the importance of analysing and understanding what the investment approach is, and particularly I find this for retirees, understanding what's going to drive the returns and if that's something you're comfortable investing into and staying with.
Yeah, agreed. I find this putting this back to the context of our discussion. How can you evaluate your own superannuation fund here? Part of this too comes down to who you are as a person. If you are someone that would like to have more control over your superannuation, then you are going to value having a wider range of investment options. You're going to value having more flexibility around where you put your money. And you're going to value having more transparency around where the money is allocated, because if you want control of anything, then actually understanding it is a primary thing that you require in order to make good decisions. Alternatively, you might be an individual that says, look, I'm actually pretty comfortable with, it's not something that I either take interest in or it's not something that I want to make a priority. I am happy to entrust this to my superannuation fund or superannuation funds. If that's where you are, then the breadth of investment options and the level of transparency that they offer is likely to be less valuable to you. So this is where you as an individual can self-reflect to understand, well, what are my expectations if I want to invest my money, and therefore how does my existing fund stack up?
There's probably two key things I look at when it comes to performance, and two things I always suggest, which is don't compare yourself and your fund to the top performing fund. Like always compare to the median. So the median is the one that sits in the middle of all the returns, because the top fund's going to change every year. And we know past performance, no guide to future performance, but it's like literally the only thing that people focus on. So compare yourself to the median, and these benchmarks are easy to find. Are you doing around the average? Ultimately, when you're investing in these kind of risk profile, asset allocation driven portfolios, you're expecting a return of CPI plus 3 to 4%. Is that not every single year, but over the long term? Is that being achieved? And where does the median sit? There'll always be outliers on the top end and the bottom end, and you just want to make sure you're not that outlier every year.
Yeah.
And then one thing which is very difficult to assess is, particularly in this sector, is risk-adjusted returns. So what's the experience of you've had to get to the returns that you achieved, but incredibly challenging to measure.
Yeah. Perhaps one of if you're listening to this and wanting to deep dive into that, understanding where the return has come from, like if whether it's outperformance or underperformance, the level of performance you've got, is that because this particular super fund or the fund that you're in had a really big exposure to the NASDAQ, the US market last year? If that's the case, that market put on 30%. So a bigger exposure, guess what? That's going to really inflate the returns that you had. Conversely, if that same super fund had decided, no, we're going to have a really big exposure to the ASX 200 over the last 12 months, it would only have achieved 12% over that same time frame. And again, that's flowing through the portfolio. But you are getting more risk by overexposing to certain areas, and of course, that's going to have an impact on your portfolio over the long term.
Yeah, and in retirement, I don't want to be at the top or the bottom. I want to be in, the number one or the number 300. I think most people want consistency, and they want to be, if you're in the top 20, top quartile every year is essentially what you're looking for, not peaking and troughing. And that means you're not taking these big swings. You're not over allocating to different sectors and trying to be smarter than everyone else, but just relying on the benefits of compounding and staying exposed.
Yeah. Get rich slow.
Yeah, exactly.
Let's go to investment fees. Huge thing for anyone who's evaluating a superannuation fund.
Yeah.
Let's make this short and sharp. How do you evaluate the investment fees that you have in your super fund, and how do you know if that's acceptable?
I think most of the time these days, their fees aren't really hidden anymore. There were, historically, there were a lot of hidden fees.
4.5% contribution fees.
Yeah, exactly. Exit fees, all these kind of nil entry fees that were actually exit fees, all these kind of things. But we see it as three types of super funds. So you've got an administration or a platform fee, you've got an investment fee, and you've got an advice fee. For the purpose of this, advice fees are relevant. We're just talking about the fund itself. Your admin fee is your account keeping, cost of doing business, and the key place is you could always find these in your product disclosure statement or in a fees and costs addendum that comes with it. The challenge is understanding what fees paying for what and how relevant they are. Admin fees, you're generally looking at anywhere, you want these to generally be below, I think, 0.2, 0.15% and lower is where you see most of the industry, and both the industry funds and corporate super options are generally around that level. If you're above that, it's something you should be looking at. And investment fees, this can be incredibly broad. So this is and it's interesting from an industry fund perspective because your investment fee is paying both for the fund managers that they're employing, but also their internally managed teams. So it's very difficult to break up who you're paying what. And I'd say on average, the investment fees are somewhere between 0.6 and 0.8%. Is fairly competitive, and that will generally be including internalization and a portion of active management within those portfolios too. That's where I'd probably sit the benchmark.
Yep, I think that's pretty reasonable.
And that excludes, because as advisors, we're constantly getting compared to industry funds, but all you're paying for is investment management in that fee.
Yes. Yep. The other consideration here is the distinction between your, for example, a single management fee that might come in the form of an MER versus other costs that are here. So, for example, often you might find that a particular fee has what's called an MER, a management expense ratio of, let's say, 0.65%. But then they've also worked out that they have average transaction and performance fees of another 0.15%.
Adds to it.
That ain't 0.65, that's 0.8. If that fee is happening every year in, year out, that's the average over the last decade, then the fee is 0.8, not 0.65. So the product disclosure statements are actually pretty good here. Typically when you open those and you're looking at the fee, it'll just be on a table and you can see what their best guess around the all-up fee. Just understanding those differences is really important. And
you have to keep checking it every year because investment decisions and performance fees, as you said, actually your management fees or your investment fees are actually an average of the previous year. So if something significant changes, if there's big performance fees or new managers, your fee can actually be higher than what was quoted without having to be disclosed.
Now, the thing about fees for me is in the same way that trying to get the highest return is often overemphasized when it comes to what super fund should I be, and trying to get the absolute lowest fee is also overemphasized. And I can easily use myself as an example here, because I have made more money by a distance in my superannuation fund let me rephrase this. The biggest attributor to the growth that I've had in my superannuation fund in my years invested has come from the highest fee paying investments. And that investment was a geared investment, and the fees for it are 2.27% per annum, and they have been about there for the entire time. And I chose that investment despite the disgustingly high fee. I chose that investment because that offers the highest level of gearing available versus anything else in the markets of it that I could find and be heavily invested in. Now, if I had said, no, thank you, I want a geared investment, but I really don't want to pay the 2.3%. I want to pay something that's 1.4 or 1.3%. I absolutely could have done that, but I would have been less exposed and I would have got significantly less growth. So hooking back to performance, we talked before about and investment options. We talked about you making an evaluation of what part of this are you going to value. That fees discussion is just stapled onto that. If you have fee or features inside your superannuation fund that you say, yeah, I value that. That is in line with my preferences. It gives me that control. It gives me that transparency, and I'm practically using those features. Well, then you can justify the higher fee. If you don't use any of those features and your fees are high, that's where you should be saying, this is not a good it's not a good product for me, because I shouldn't be paying a premium for these things that I don't use or I don't value.
Yeah, is there a mismatch? And that's why you can't just set and forget. I think it's important. Hopefully this is what triggers this, is you're reviewing your super fund as often as you would not as often, but regularly as you would your investment portfolio or your investment property or any other assets.
Do you have a rule of thumb? Like, if you're a pre-retiree, is there a particular fee whereby you'd say, look, if you're under this, like, all up fee for platform fee, management expense ratio, that kind of thing, is there a particular number that you'd say if you're under that, then you're probably okay?
Generally, and this is excluding advice fee. We're aiming for something like under 0.75.
Yep.
In a platform and investment outsourced investment management costs.
Yeah, brilliant.
You add advice fees, and advice includes both investment support as well as strategic advice, and that obviously increases. But I think you can deliver it below 0.7 to 0.6 in some cases.
I agree.
But you have to be careful what the way off is. The trade-off is not the way off. You can get very low cost, as you were saying, but you have to accept market volatility and market risk as a result, or you can overpay for the same thing. So it's not as simple as low cost, high performance.
Yep. No, I'm very comfortable with what you said, and I think we're on the same page there. So let's keep moving. Let's go down to insurance. Now, mindful that insurance is going to be or may well be less relevant for certainly for a retiree, but for pre-retirees, hopefully you're in a financial position where your reliance on insurance is reducing. But having said that, I still meet a heck of a lot of people in their 50s and early 60s and say, okay, what about your insurances? And they say, yep, I've got some inside my superannuation fund. And they're entirely reliant on that. And so by extension, the offer that's available, the insurance offering, especially if you are of that sort of person that says, look, I've never actually practically solved this, never sought out to go and solve it. I've just got what the default is. The insurance offering is really important, right?
Yeah, and the key questions here are what type of insurance are they offering? How does it compare? And you can easily compare the cost on a very basic level to other superannuation funds. So how does it compare in cost? What are the things, if we're looking at this from a retirement perspective, in a lot of cases your cover reduces but your premium goes up. So how do they treat you as you age, and how does your policy change? And then what are the big one I'd probably say, because the most I think the most valuable insurance tends to be an income protection policy, is what are the terms of that policy? How hard is it to get a payout? And will it last till you're 65, or will it only pay you for 2 years? And this is probably getting into the weeds too much, but they'd be, again, the cost and the level of exposure you can get and how they treat those nearing retirement would be the key considerations.
Couldn't agree more. Yeah. And to add to this, again, highly situational, but I have sat down with people who have high fee paying funds that are not in line with their overall investment preferences, and concluded that we should leave at least some money in that because of the insurance offer.
Just to keep the insurance. Yeah. I mean, I do.
Yeah. And so if you're in a situation where you feel that, hey, if anything was to happen to me, I'm not so sure what my family would do without this insurance, or me on my own, if I was to become unable to work due to illness or injury, I don't have that financial net. I don't have that big amount in offset or whatever it would be to help self-fund that next period. Please, you need to overweight the importance of insurance. And frankly, as you've said, insurance tends to get automatically reduced as you approach 65, or even eliminated. That's the default for most public sector superannuation funds, and indeed a lot of retail superannuation funds. We've got insurance stapled to that. And so understanding how does that change over time? Is that going to work for me? And practically, if it's not, I need to get some advice here.
Yeah, for sure.
Yeah. Okay. Let's go to access and comms. So as we said before, in my mind's eye, there's two things here. The first one is around how easily can I reach my superannuation fund? Can I ask the questions that I need to ask, get the answers that I need? If I need to update my binding death benefit nomination in my fund, how easy is that? And how simply can I do it? That's part one. We put that under the category of access. And then over beyond it, we've got communications, which is what practically do I get back that I find valuable? If you're getting a lot of communications, well, if you don't read them, if they just sit in your inbox and then just float down until they disappear, yes, it's nice to be getting them, but they're meaningless to you because you're not actually engaging with it. So how should people evaluate the importance of access and communications for their super funds?
And that's exactly right. Which on communication side are they providing content that's relevant and helpful to me? And is the content I need? So, I'm thinking about retirement in 5 years. Is there something that can help me make those decisions? And as a general rule, the industry is not particularly good at it, but it is improving. So are they offering, are there podcasts? Are there video updates? Are they explaining their investments? Are they offering information sessions where you can go and learn more about your situation? So that at these days should be the very basic. You should be able to access relevant information as quickly as possible, and you should be able to access and speaking to people is the next challenge. And I don't think you can answer this until you've tried during a crisis, because there's, you can imagine there's millions. Australian Super has 2.3 million members or something like that.
I'll confirm.
And naturally, they prefer you to interact via the app because it's simply nearly impossible to deal with 10% of the population as a member base. So, how good is their applications and their accessibility that way? But also, when you do really need to talk to someone, is that possible? And we won't go into this one, but going onto Facebook and social media pages, yes, they don't always they either attract the really happy or the really unhappy people. But looking at people's experiences on those can be incredibly valuable in helping determine your fund. But don't just look at one or two; look at all of them. Not that we all like going deep on Facebook comment threads, but I think that's basically peer reviewing.
Yeah. The in answer to the question, it was 3.4 million.
3.2.3. I understated it by 50%.
Big numbers. Yep. Yeah. Okay.
That's more than 10% of the population.
Now, the last two we've got down here, we've got marked down as the perks and the quirks. Now, practically, I think we should just do this at a high level because it's going to be hard to get into the weeds. It's very dependent on each individual fund. But when we talk about the perks, of course, we're talking about the good features. What makes them different to their peers?
Tennis tickets.
What are the things, again, that you value? Not just stuff that's oh yeah, that seems pretty good, but what are the real benefits of this fund, the reasons that I'm still here? And then similarly, the quirks, these are they're the inflexible features, the things that are lacking versus their peers. And especially if you identify something where you say, oh, that's not quite going to work for me. And we notice this a lot when we're giving financial advice, which is we might look at a fund that someone's with and say, actually, that fund seems fit for purpose right now. That'll do the job. But we're only a few days, weeks, months away. Or if we try to execute on this particular strategy, which is going to save you a bucket load of tax, for example, it's going to actually be really, really difficult to do in this fund because of some of the inflexibility that they have.
Yeah, for sure. And perks can be as simple as usability. Like the perk could be that the application works well. The other ones to look at, a lot of the funds offer discounts to certain things. If you're associated with them, I was joking about tennis ticket. I don't think they give away tennis tickets, but there are all kinds of perks you can get. But I think so much of this comes down to usability and accessibility of information that you need. And it could be the quirks would be exactly the same. If you've got a poor app, you've got a poor website, it's difficult to open a new account, transfer between accounts, update your buying nominations. That's going to be a challenge. And I think and as you can tell, it's what people individually value for each fund. But we can have a look, and I think it'd be valuable. Maybe we'll start with, I've got an industry super fund and an SMSF, so maybe the first one we'll look at mine, and we can go through the process and find out the areas that I like and don't like about it.
Yeah, well, I'm glad that you mentioned that, because that's exactly what we are going to be doing. Over the next little while, everyone, we're going to be going through the major superannuation funds, the biggest funds in the country. We're going to start off, or my intention, welcome your comments through, my intention was to start off with Australian Super, Host Plus, and HESTA. And so we are going to apply these principles, and talk about what's good, what's bad from an investment perspective. What do we like about it? What are the things that we feel need improvement? And just give as impartial as we can a partial assessment of these particular funds one at a time. Now, as part of that, for these first three funds, we were lucky enough to have many terrific questions coming through, and thank you to everyone that submits questions to the show. If you are with Australian Super, Host Plus, or HESTA, and you have a little question that maybe you just can't get an answer to, then please flick it through. We will take the opportunity to look at those, and as part of our assessment, we'll do our best to make sure that we answer the questions that you're not sure about. So
maybe we can get Mark Delaney on here too.
Okay. So please reach out. We love getting your questions, and we'd love to help you as best we can. Mate, thank you so much for a great show. And to all of you listening, hopefully that's been really valuable. Hopefully that gives you that first meaningful step to properly make an assessment of whether or not you're in the right fund. And from there, if you're continuing to make those evaluations, then hopefully that puts you in a really good position over the long term with your super.
I think I stayed objective, so.
You did a great job. Yeah, there was no fire and brimstone. Good on you.
Did my best. It was hard.
All right, guys, thank you so much. Looking forward to seeing you next Thursday, and chat to you soon.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.